Hello and welcome to Finextra TV's Thought Leadership series. I'm Hannah Wallace, and today we're talking about the volatile business landscape and the implications this has on the commercial lending portfolios. To guide us through the topic is Gareth Rees, Product Director for Experian Business Information, UK and Ireland. Hi Gareth, thank you very much for joining us today.
Hi Hannah, thanks for having me.
No problem at all. So yes, I think it's fair to say the UK has seen some unprecedented times, with businesses closing in recent months and some services being no longer required, leaving others maybe in greater need. But perhaps this is a pretty dismal view of things. So I'd like to hear your thoughts on the matter. How have you seen the market change in the last 6 months?
So you're absolutely right. We have experienced over the last 6 months an unprecedented experience in terms of how COVID has impacted both people and businesses. And there is a lot of bad news out there, and a lot of pictures of and portraits of businesses failing left, right, and centre, and everything going to the wall. And whilst that absolutely has occurred, and a lot of people have suffered financial hardship and business hardship throughout the last 6 months, the numbers don't necessarily reflect what the media have portrayed the market to be at the moment, which is quite interesting, and perhaps some people might think slightly a preposterous thing to say based on what a lot of the things that they've heard. But if we dig into the data, there are some strange patterns that have emerged over the last 6 months, which you wouldn't necessarily have expected to have seen at the beginning of lockdown back in March. So if we look and think of some of those types of insights, the number of businesses that are actually failing and dissolutions, etc., that have occurred over the last 6 months is significantly less than what happened in 2019. I think it's almost about a difference of 110,000 or so businesses more failed in 2019 or failed in 2019 versus 2020. And I think that doesn't necessarily echo what people are reading and assuming has been happening in the market. I think we absolutely know two ways about it. We've seen unprecedented lending volumes. If we look at the numbers through May, June, July, we've seen a 500% spike in lending in that time. And obviously this is as a consequence of the different government initiatives that have been launched to support and save small businesses. But if we also look at, weirdly, the number of companies that have been incorporated versus this time last year, again, the number in 2020 is already surpassed the number of incorporations in 2019. So it's quite an interesting statistic when you think of it's just a period of failure as opposed to green shoots of recovery. But I think there is some potential logic that sits behind those numbers that would be good to actually dig into to understand better.
And of course, we've got the intervention measures offered by the government, such as the coronavirus business interruption loan scheme and the bounce back loan scheme, alongside these multiple furloughs. So there's bound to be an impact on the commercial lending environment, as you say. But what would you say is sort of the realistic view, as it were?
Yeah, so obviously, as you mentioned, there's been an enormous amount of government initiatives and support there for small businesses since lockdown basically began. It didn't necessarily start out that particularly well with CBILS and the pace at which people were able to draw down lending and actually get approval for lending for a variety of different circumstances. BBLS came along and was the saving grace for a lot of small businesses who were really at that point of desperate need, just in order to keep the lights on, to pay minimum salaries based on the fact that furlough was in place, etc. by then. And if we see the sheer volume of lending that we've seen, over 1.2 million businesses have been supported by either CBILS or BBLS, amounting to around £50 billion in lending. So unprecedented lending volumes in that period. I think the worrying statistics that are coming out, though, is around the amount of bad debt that sits within that. So obviously, we've seen that the number of dissolutions in 2020 so far have been less than the same period in 2019, which beggars the question whether there are businesses out there that would have failed had not COVID occurred. and this is almost their last chance saloon for a lot of businesses. And I think there is a real risk around giving rise to the zombie business, zombie companies becoming more prolific in market. Something very similar happened in 2008. But I think bearing in mind or comparing 2008 with now, the 2008 we didn't have those government schemes to rescue and keep businesses alive and supported. And I think the economy is potentially a little bit of a false economy, but potentially at the moment. And actually, the real rot and concern and risk is actually a little bit further downstream to where we are today. I think if we also look at the number of Beebles loans and overlay that with the number of business accounts being opened around the time of launch, it was a requirement to have a business bank account for Beebles. It does beg the question of where have all these people suddenly come from to suddenly be needing to open a business bank account now and not 12 months ago or whenever that period it might have been. Now, some absolutely can be explained by the fact that they may be non-limited companies and they may have been running their business out of their personal accounts. But I think there is no two ways about the fact that there is a real risk of fraud within those numbers, the Beebles numbers. And I think a lot of lenders are worried about the levels of risk that they have now got on their books and are responsible for collecting that money. If we look at some of the statistics around Beebles, approximately 13% of companies that Beebles is now supporting were already in that high risk category or from a credit perspective. And therefore, would they ordinarily have been granted funding if we were in normal times? So it does raise a level of concern around where is all the money going to come from in order to pay back the loans that have been drawn out? Are people just suddenly going to do a runner, so to speak, and leave banks in the lurch? But time will tell.
Right. So yes. So what do firms need to consider then when they're thinking about their models and strategies when it comes to commercial lending, both in the short term and long term? Then.
So I think very much in the short term, sort of looking at the fraud element. I think it's very much looking at the potential for the businesses that they have lent to be fraudulent, and has it given rise to this concept of Phoenix businesses, i.e. Phoenixing are companies that are suddenly literally are rising up from on the back of a failure of another company, and they look to mask who is behind that particular business. Is it those sorts of businesses that are taking the loans? But I think there's going to be a real onus and need for better portfolio monitoring to look at how small businesses can be supported over the coming weeks, months, and if not years. If you think about the Beebles loan scheme has been extended to 10 years now in terms of being able to pay back. So there is going to be a lot of debt around for quite a long time with those bona fide businesses that have taken it. So we're helping business or helping banks to understand the financial health of their customers on an ongoing real-time basis is going to be really important. It's not just about looking at a credit score, it's getting into the guts of the financial health of those businesses to help them alleviate future periods of stress where working capital might be low, thinking about close covenant monitoring to think about forbearance periods to help them through a particular time, or whatever else it might be. But absolutely trying to identify those businesses most at risk before they potentially go into default. Because obviously once you're in default, it's a costly process to go through, and by that time you may have lost all opportunity of actually clawing back any of the funding that you had originally lent. It's going to be a very interesting period to really understand, you know, how are these businesses going to be best supported going forward. And actually it's looking at more flexible models that the banks might ordinarily have today, and looking at more data points to better understand the affordability of those businesses to be able to repay their debts in appropriate and fair terms. So it is all about the fair treatment of those businesses rather than just letting everybody go to the wall. And also for the lenders, it's thinking about which businesses and in which sectors are most likely to recover and bounce back the quickest versus the ones that are always going to struggle. If we think about certain industries, the theatre industry, for example, where the theatres are still closed, etc., are those sadly going to be lost causes in some cases, and therefore do you look and put all your emphasis on those businesses that will prosper in the future and help them through that tricky period? It's about a balancing act, and trying to spread the risk as much as possible, but knowing that there isn't infinite support to look at every single business on a regular basis.
Sure, there's a good way of putting it, and as you say, really interesting to see how things develop going forward. But Gareth, we'll leave it there for now. Thank you so much for calling in. It's been really insightful.
Pleasure. Thank you, Hannah.